Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The last few years in particular have been dark, depressing and uncertain for investors, shareholders and depositors in India. And this train of debt, deceit and default as we call it has been on the fast track since 2018 specifically. Whenever an economy recedes, whenever it slows down, it becomes very difficult to hide and contain all those frauds and failures that have been committed. And that has been the case with India also. The economy has been receding, and thus all the giant crimes that were committed by the likes of Chanda Kochar, Rana Kapoor, Kapil and Dheeraj Wadhwan, Ravi Parthasarathy, Hari Shankaran, and all those unknown babus and netas because of whom Indian banks went bankrupt, their crimes have been coming out in the open with extremely boring and predictable regularity. Because when the economy starts shrinking, it becomes difficult to contain and hide financial and banking frauds. Every time a fraud takes place, every time a failure of an institution takes place, every time there's a case of gross mismanagement, lakhs of crores of public money does get lost in aggregate. And that has been the case with India also. And that public money is not just of individual investors, but also of institutional investors, finally, who represent public money in aggregate. That's what's happened in India. Lakhs of crores gone down the drain. I can run you through the list again. ILFS, 1,32,000 crores gone down the drain. And who are the investors? Not just individuals, but a slew of institutions, which includes mutual funds, PF funds, pension funds, and various others. IDBI Bank, lakhs of crores of public money would have gone waste. It is just that the government stepped in to bail it out. And of course, we lost 55,000 crores of public money lying with LIC in order to bail out a bankrupt IDBI Bank. DHFL, about 1 lakh crores of public money stuck, and it includes mutual funds and individual investors also. PMC Bank, 13,000 crores stuck. Reliance Capital, another case of default. Altico Finance, 3,000 plus crores stuck. Carvi was a shocker. Blatant misuse of money of individual investors' accounts, clients lying with the broking firm. Yes Bank was again a big shocker. It's just that the government was forced to bail it out. According to us, these losses would be much more in case the losses that have been sustained by those bankrupt public sector banks are counted. It is just that the government owns those banks, so they got bailed out. But then that bailout also came at the cost of over 3.5 lakh crores of public money in the last 3 years. Thus, all these frauds, all these failures have meant public money down the drain, and that's why we said it's been dark, depressing and uncertain days. In all these large institutions, whenever there's a fraud or a failure, apart from the public, it is mutual funds also who lose money. Because mutual funds are prolific investors in debt instruments in particular issued by these financial institutions. They have been investors in bonds, deposits, debentures, and any debt instrument issued by the likes of ILFS, etc. And when these institutions collapse, of course, mutual funds also incur losses. But then for these mutual funds, as long as the inflow of new investments exceeds the outflow, the game continues and they do not really face a crisis. But then India has been in a lockdown mode. The COVID crisis remains unresolved. Investor confidence has been going down. Risk aversion has been going up. It is a time when, in case of any mutual fund, there's an acceleration of the demand for redemption of the mutual fund units. The inflows have come to a virtual standstill. And much as the Reserve Bank claims that there's enough liquidity in the market, liquidity has fallen dramatically and significantly. Because of this situation, we are now in a situation where even mutual funds are starting to default. And that's been the case with Franklin Templeton, which announced a closure of 6 of its debt schemes. Franklin Templeton, with its closure of 6 schemes, means 30,800 crores of public money in those schemes is stuck. Investors in those schemes neither will get an entry nor an exit. Their money will be stuck till either the time of maturity of the scheme, or as Templeton says, it is able to get a new buyer for those funds such that their monies are given back. Thus, 30,800 crores stuck in Templeton funds only because they are not getting in fresh inflows. Their outflows have gone up. Liquidity in the market, as Franklin says, is dramatically and significantly gone down. Templeton says that its decision to shut these schemes has been the best option, and it has been taken in order to protect investor value. It says that it has been unable to sell any of its investments at this point of time in order to maintain and honor redemption pressures. It also says that the inflow of fresh investments has come to a standstill, and this, it says, has happened because of COVID and because of the continuation of the lockdown. It says that liquidity in bond markets has been extremely poor, and that is the reason why Templeton says it has closed down these schemes. It has shut them down. It will wait, try to get a buyer, or it will wait for the redemption of all the monies that it had invested in these debt schemes and pay off the investors. Only time will say how much of that redemption will get honored, but the reality is investors in these schemes are certainly headed to incurring losses. In order to assuage feelings, or just to, for the sake of PR, Templeton says that it is deeply committed to India. It also says that 1/3 of its global staff is in India, and it is saying that it is trying to salvage the situation. All those who are going to be affected by this closure of Templeton schemes are investors. Are those investors who are either high net worth individuals or corporates or institutions or even individuals who invest in these schemes in order to get a better return on their investment as compared to bank fixed deposits. All their strategies have come to a knot with the closure of these schemes. AMFI, the Mutual Fund Industry Association, says that there is no need to panic. There is need to be cautious, but there is no need to panic because AMFI says that these schemes constituted a mere 1.4% of the total assets under management in the mutual fund industry, and thus there is no reason to worry. There can be no contagion effect. Well, as far as we are concerned, we are not convinced by what AMFI says. Investor money is stuck. The lockdown continues. The COVID crisis remains unresolved. And for all you know, this might be a trigger of a contagion effect on the entire mutual fund industry, which is anyway witnessing a huge demand for redemptions from its investors. What is the larger picture arising out of this particular closure of schemes by Franklin Templeton? The first one and the most obvious, liquidity is scarce in the system. Much as the Reserve Bank governor likes to say that there is enough liquidity in the system, the reality is not so. The Reserve Bank governor also said that there is enough liquidity in the corporate bond market. But one of the reasons for closure of these schemes cited by Templeton is that the corporate bond market liquidity has been suffering. Thus, somewhere there is a problem. Reserve Bank tries to pump money into the system, but it doesn't reach those who need it. This liquidity scarcity, according to us, will continue for the simple reason that those who need to lend in the system, which is banks, are not lending. The second issue that emerges is, and the most obvious, that risk aversion in the system is going up. Redemption pressures will thus go up even further. A situation could come where the entire mutual fund industry is going to be in a problem for the simple reason that investors, as they get more and more scared and as they fear the continuation of the COVID crisis, they are going to seek their money back and ensure its safety. Redemptions going up would mean that the money would finally land with banks. And that's because investors are doing that. They are sacrificing returns and trying to ensure safety of their funds. And what's safer an avenue in India than deposits with public sector banks? And that's where the money is going to swell. Unfortunately so, for the simple reason, money reaches these banks and they don't lend it. They just hand it over to Reserve Bank, which only deprives the entire system of liquidity. This vicious cycle will only get aggravated further as the lockdown continues. To us, this closure of schemes by Franklin Templeton is a serious issue. it can have a contagion effect, and that will have to be watched. And the only way to prevent the contagion effect down the line could be that the RBI or the government will need to step in somewhere to bail out the industry. Let us see how the redemption pressures build. That will depend on how soon is the lockdown lifted up. The long-term solution to this is to ensure that there is growth in the economy, is to ensure that the economy revives, is to ensure that demand and supply both increase. And that's the challenge which the world and which India also faces today. As far as the investors of Templeton in these schemes are concerned, their money is stuck for an uncertain period. And whether Franklin Templeton is committed to India or not is completely irrelevant to the woes that they face at the moment. 30,800 crores of investors will be stuck in Templeton schemes till they either get a buyer or till the redemption takes place, both of which come with a sense of uncertainty. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.